Hello and welcome to the BDTV Breakfast Show. This is the big story where we turn a spotlight this morning on a major shakeup in the global energy industry. All majors from Chevron to BP are slashing jobs, freezing investment and putting drilling on pause. Crude prices, once soaring after Russia's invasion of Ukraine, have now halved, trading just under $66 a barrel. Analysts wonder it could fall even further below $60 with ripple effects that could last 4 years. Now, from the shale fields of Texas to the oil rigs of the Middle East and the offices of London, Kuala Lumpur and Lagos, the message is the same. The boom cycle has ended, and at least for now, we'll say, with capital spending declining, workers losing jobs, and countries like Nigeria facing fiscal strain, the big question this morning is, what does this retrenchment mean for the future of global oil and for economies heavily dependent on petroleum revenues? Well, joining me to unpack this and so much more is Dipo Oladehinde, is the head of BusinessDay's Energy Desk. Welcome to the show, Dipo. Hi, Dipo, if we can hear you, so we might need you to unmute your mic, please.
Yeah, hi. Good morning.
It's good to have you, Dipo. Let's really talk about and start with the big picture. Why really would you say oil majors are pulling back on drilling and investment now?
Okay. Good morning, everyone. Good to be here again. So, I think what we've noticed is the fact that capital spending on oil and gas production has dropped. $41 billion US dollars. This is the first major decline since 2020, and this data was published by McKinsey. So what we're seeing is there's been a drop in capital projection for oil and gas projects. A lot of companies are reducing their drilling sites and their oil exploration plans. This is as a result of the movement in global oil prices. So oil prices, the outlook at the beginning of the year was the fact that as of September, oil prices should be over $80 per barrel. So what we've noticed now is we're currently seeing it in the region of $63 per barrel, which is affecting a lot of companies' ability to spend going forward. So what we've noticed as well is a lot of banks that are promised to give out loans for oil and gas projects are currently taking a back foot, are currently rethinking that position as a result of oil prices. Excuse me. So, I mean, this is the major reason, and then of course, knowing the fact that OPEC oil producing countries are all also increasing supply to the markets. So we are currently witnessing a bit of glut in the market because a lot of countries are currently producing at their full capacity. So that means there is excess supply of products, and in the normal law of economics, once supply is excess, the prices are bound to drop, which is what we are seeing currently in the markets.
Before we continue, could you please turn on your video so we can have you on video, because we've been hearing you but we've not been seeing you. Well, crude prices also, we've seen that they've dropped sharply since their 2022 highs. How much of this downturn is about the OPEC Plus strategy versus the weaker global demand?
Yeah, thanks for the question. So what we've noticed in terms of demand as well is the fact that the current demand you're seeing is still peculiar. It's not a surprise because in times like this, you expect increase because in summer periods and not first period. And so a lot of the local countries right now demand of energy as a result of due to so many reasons, right? So I mean, demand is always expected. I think the biggest challenge we face is supply. OPEC plus countries as well are also they had an agreement last month to increase supply to the markets. I mean, this is also, I mean, all of this is definitely have an effect on price because, like I mentioned earlier, once supply is in excess, what we're going to see is prices will probably fall. Another major thing that is driving supply, the case will be now, we've seen the likes of Saudi Arabia and the likes of Iraq and other major oil producing countries scale up oil production. So what they've been able to do is they've been able to revise some of the idea of the assets and they've been able to boost production back to their peak levels, not since the beginning of the year. And so all of this is causing supply into the market. So that's the major responsibility for falling price. And of course, it's also having a multiplier effect on drilling plants for oil and gas.
A sweeping job cuts over time now. We've seen thousands of workers across Chevron, across BP, ConocoPhillips, even Petronas. What does this tell us about the health of the industry?
So the health of the industry is always vulnerable to crude oil prices. So all of these are not completely shocking for anyone who has been in the sector for more than say 3-4 years. So what we've seen in times like this is they'll probably reduce drilling plan now and then scale up drilling plan again when prices go up. So it's not a new phenomenon. It's a phenomenon that we've had to contend with. I mean, the oil and gas sector is very versatile sector. So volatility is the name of the game. So how you're able to navigate the wind during the volatility period, it will show how resilient you are and how you are able to compete and break your peers. I mean, nobody is new to volatility for oil prices. This is why companies respond to it differently. Some companies will respond by cutting jobs. Others will respond by basically maintaining status quo and taking heavy debts, which they will offload when they are making excess money from crude oil. So again, different companies manage these things differently. For some, their loan due to definitely go up. For some, they need to reduce their current expenditure. For some, beyond just tickets, they need to take more loans in order to adjust for any of the inconveniences they are currently facing. So, I mean, all of these things are not new for anyone who's playing the oil and gas. I think the big boys are used to it. The ones who are not vulnerable, the small companies who are not used to this kind of volatility. And so for companies like that, it's very scary.
We're also seeing that some companies are outsourcing and they're leaning on automation. Even AI, they're also leaning on AI to cut costs. Do you see this as a long-term structural shift or just a temporary survival tactic?
So whether they are volatilities or not, I think AI is competing in every sector of global economy. So there is AI in almost everywhere. AI is attacking publishers, who are attacking those in the fintech. AI is attacking every major sector of the economy. So AI is something that is trying to stay and it's something that will continually be running going forward. So whether we see volatilities like this or not, my view is AI is always going to compete and always going to give everyone discount for their money. It just depends on how you're able to adjust quickly, or because again, if you don't innovate, you probably phase out. So a lot of companies are definitely innovating now. The oil and gas companies are not like that. So it's just a major coincidence that we are seeing this kind of volatility times in the exact time prices are dropped.
Right, Dipo, we just need you to please put your audio up a bit so we can hear you a bit louder because we can hear you clearly now. While we move on, really, what does this retrenchment mean for Nigeria? Because we know that we are heavily reliant on oil revenues to fund our budget. So what does this retrenchment mean for us?
Oh, okay. So is my voice clearer now?
Yes, much better. Thank you.
Oh, okay. So we've not seen this kind of retrenchment in the local markets. So all these developments we are seeing is currently in the global market. So we've not seen it yet in the local market yet. So the likes of Chevron, Rwanda, and P, majority of these guys are not announced any major retrenchment or not retrenched or anyone that I am aware of or that the media is aware of. But like I mentioned earlier, majority of the local guys will probably would have edged against ones like this. So what companies usually do is to edge their oil prices.
Please carry on, Dipo. We can hear you clearly.
Okay. So majority of the oil and gas companies are probably edged their oil prices for within a certain window. So for instance, sometimes they can put their oil projection within a range of $63 to $65 per barrel. And I mean, all of this is determinants on how the company as well is able to boost oil production or how they are able to scale up their pipeline operations as the case may be. Beyond the oil and gas, a lot of companies are also investing in gas. A lot of companies are looking to power as the case may be.
All right. We're also seeing that there's an argument that cutting investment today could actually set the stage for a future supply crunch. Are you in agreement?
I couldn't agree with the question.
We've seen that there's an argument. We've been seeing an argument that cutting investment today could actually set the stage for a future supply crunch. Do you agree with that?
No. So, I mean, cutting investment is a temporary thing. Different companies will definitely adjust when the prices are moving up again.
And given this turbulence, how are investors reacting? Could we be seeing cuts in dividends and buybacks that have long attracted shareholders to oil majors? Dipo, do we still have you? All right, this is the big story right here on the BDTV Breakfast Show. We'll take a quick break and we'll be right back. Well, that's been the big story right here on the BDTV Breakfast Show. I've been speaking with Dipo Oladehinde, the senior energy correspondent here at BusinessDay. But that's as much as we can take this morning. Up next is social listening. Do stay with us.